and welcome to our Chapter 6 Fraud and White Collar Crime lecture. We're going to cover the definitions for fraud and we're going to describe white collar crime. Forensic accounting has become affixed to the terms fraud and white collar crime. A primary consequence of fraud and white collar crime is economic loss. Accounting professionals, especially auditors, are viewed as like the principal guardians of the public interest, like defenders against these types of financial crimes. So the pervasiveness of fraud and the public outcry that accountants should respond to it has moved forensic accounting into center stage. So forensic accountants are uniquely skilled in order to do fraud deterrence or fraud detection and fraud investigations. Forensic accountants have an understanding of the judicial process, including the rules of evidence and the requisite burdens and standards of proof. So this will offer us a unique perspective of financial crimes, highlighting 5 key points. Financial crimes are criminal offenses. As such, the standard of proof is beyond a reasonable doubt. The burden of proof is on the prosecution. Financial crimes are crimes of intent. Absent of an admission, there's circumstantial evidence that could include expert witness testimony that's used to establish or infer that fraudulent intent. Financial crimes are not victimless. In addition to the economic loss, financial crimes can have emotional and physical harm to the individuals. Financial crimes may involve violent acts. Although white-collar crime is generally considered non-violent, there is a potential for violence, and that cannot be ignored. And the government or the prosecution is not always right. A criminal intent is not proof of a crime. It's just an assertion that a crime has been committed. Importantly, the law presumes that every defendant is innocent until proven guilty. So now let's talk about fraud. Fraud is the unlawful taking of another's property by deception. Fraud is different from robbery in that robbery you use force to persuade somebody to surrender their property. Fraud is the use of deception that you're still persuading someone to surrender their property. So under common law, fraud has 4 basic elements. You have a material false statement or omission. The suspect had knowledge that that statement or omission was false. The suspect intended to induce the victim to rely on that false statement or omission, and the victim did in fact rely on that false statement or omission and suffered injury or damage as a result. A common thread among fraud definitions is that fraud is a crime of intent. It's an intentional act, is a product of free will, right? You're meant to do it. That is, you have a guilty mind. In other words, the act itself does not create guilt, the criminal intent, unless the mind is also guilty. So the challenge of establishing this criminal intent is why we don't prosecute children, for example. So there's evidence of fraud, right? You have absence of a confession, you'll have like direct evidence, which is pretty much circumstantial evidence, and it's used to establish fraudulent intent. So the reliability of circumstantial evidence for the purpose of establishing intent depends on 2 factors: alternative explanations and a degree of impact. So if there is no alternative explanation for some observations, such as like overlapping, then the degree of impact, which is the significance of the observations in relation to the issue in question. Now let's focus our attention to white-collar crimes. That's a major subcategory of fraud. So the term white-collar crime was coined by Edward Sutherland, a prominent criminologist, in 1939, and he defined white-collar crimes as a crime committed by a person of respectability and high social status in the course of their occupation. There are 6 attributes of white-collar crime: deceit, which offenders misrepresent and conceal the truth; intent, fraud does not happen by accident; breach of trust, offenders are generally in a position of trust that is manipulated or breached to facilitate the fraudulent action; losses, usually it's an unlawful taking of another's property; concealment, white-collar crimes can continue for years and never be discovered; and outward respectability. Basically, white-collar crime is commonly done by individuals like professionals and executives who are seemingly beyond reproach. So the Commerce Clause of the U.S. Constitution gives the federal government the authority to police white-collar crime. And there are several agencies, including the FBI, the IRS, the Secret Service, the SEC, the EPA, and U.S. Customs that participate in the enforcement of federal white-collar crime legislation. And in this figure, you'll see types of white-collar crimes. There's some debate as to what qualifies as a white-collar crime, but this pretty much has a variety of frauds that are committed by professionals, corporate leaders, businesses, and public officials for unlawful gain. And as you can see, all of the types of frauds and then the act and activity. So we have securities and commodities fraud, corporate fraud, healthcare fraud, mortgage fraud, financial institution fraud, insurance fraud, mass marketing fraud, money laundering. There are other major categories of white-collar crime that are outside of the primary jurisdiction of the FBI, and these can include like tax fraud, mail fraud, social security fraud, food stamp fraud, immigration fraud, and bank fraud. And these are investigated by other agencies such as like the IRS, the U.S. Postal Service, the Secret Service, the Social Security Administration, the Department of Agriculture, and the U.S. Immigration Office as well. And this concludes our lecture for our Chapter 6, Learning Objective 1.